In this short video, we'll discuss the interaction between transfer pricing and customs. In many respects, transfer pricing and customs move in opposite directions. I refer to it as the inherent conflict. Let's have a look at the following example. Let's assume that we have an ex-US manufacturing entity which sells handbags to a related US entity that is engaged in distribution. The US entity is characterized as a limited risk distributor and purchases the handbag at an arm's length transfer price. The transfer price is also the price that is used for custom purposes, and duties are paid based on the appropriate tariff. The higher the transfer price, the less operating profit for corporate income tax, but custom duties will be higher, and vice versa. On April 2nd, Trump announced various reciprocal tariffs. The high increase in tariffs sparked concerns and drives companies to seek solutions in order to minimize duty costs and in order to stay competitive. Let's take a look at two potential arm's length transfer prices to the same handbag. In our prior example, I mentioned that the US distributor was classified as a low-risk distribution entity. Let's assume that each handbag sells for $200. The arm's length transfer price that is set between the manufacturer and distributor is $155. With a transfer price of $155, the manufacturer earns most of the profit, $95, which is the transfer price minus the cost of production. However, let's assume that the US distribution entity owns the intellectual property related to trademark, manufacturing, and technology. In that case, the arm's length transfer price is only $66, ensuring appropriate manufacturing return to the manufacturer. In the prior example, I showed how it is possible to set a lower transfer price and avoid high custom duty. It's worth mentioning that in order to lower the transfer price in the current example, a business restructuring would have to take place in order for the US distributor to acquire the various intellectual property rights. That is referred to as reshoring the IP. There are additional potential solutions to avoid high declared custom values. For custom purposes, it is possible to value the good using the first sale rule or split the tariff costs. The first sale rule may be applicable in more complicated supply chains than what was shown in the example. Splitting tariff costs refer to an agreement that is reached between related entities to split the tariff costs such that not just the manufacturer in our example bears it. Thank you for watching the video. For more information on transfer prices, transfer pricing planning, customs, and any other related tax issues, please feel free to visit my website www.tpwright.com.